Hello, James Blacklaw's JB Commercial Finance here, and today I want to give you a very quick explanation of why you're not tied into a commercial finance deal forever. Now, when you look at a deal for a client, you look at their circumstances, you look at the sector they're in, and you look at where their financials are, and depending on that is where you position it in the marketplace. So whether it goes to a high street lender who maybe offer it at X interest rate and X charges, to what we would call a tier 2 lender, so someone who offers slightly higher interest rates and slightly higher charges, or someone at the sort of the lower end of the scale who their current circumstances dictate that the only deal you can actually get for that moment in time is with a niche lender who offers them yet higher interest rate charges, but it's still effective for them to actually do the deal. Now, some customers can get quite frustrated when you look at their circumstances. They perceive their business and their individual circumstances a different way to what us and the marketplace does, and that's the beauty of being fully independent. The market is what the market is. If your deal is a high street deal, then you'll get high street rates. If it's not, you won't, and it's your decision whether you wish to proceed or not. But it's very important to remember that if you go into a deal at, let's just say, the tier 3 level, so you're paying X interest rate, then you're not on that rate for the rest of your life. It's in your interests and it's your incentive to actually improve your business performance, to get things going, so then you can work with someone like myself or do it independently to move up what I would call sort of the food chain. So if you took out an interest rate of, let's just say, 8% with a minority lender, because they're the only people who will help you, well, you want to be reviewing that in the same way you review your residential mortgage every 2, every 3, every 5 years. Now, when you fix your interest rate, yes, there can be restrictions to getting out of that, but a majority of commercial deals are still not fixed, and there may be penalties involved in getting out after 2, 3, 5 years, depending, but they reduce as time goes on, and quite often there's none whatsoever. And that's why it's important to have a broker or someone you trust to look at the fine print to make sure that you know exactly what you're signing up for. So the general idea when I see a client who may well be hovering towards the lower end of that value chain, they may have historic bad credit history, they may have some financials that show a loss-making year, or they may need to borrow more than a bank would normally like. So a bank might say, we're happy to do the deal, but we're only able to lend you 60%, or they might need to borrow 75%, in which case they're probably going to have to go to a more minority lender. But in 2 years' time, that debt will have reduced. Their credit history may now be clear. They may well now have had a stonking year and be making some good money, at which time it may well be cost effective to actually look at moving that deal. Yes, there may be some transactional costs involved in that, an arrangement fee, evaluation fee, but now increasingly a lot of high street lenders are doing some deals that they really want to get without any arrangement fee or with discounted legal fees or whatever it may be. So it's certainly worth looking at it, always reviewing your commercial deal, especially if it's a large commercial mortgage. Don't get me wrong, if you're borrowing £20,000-30,000 over 3-4 years, in all honesty, you're probably going to keep that deal the whole term. If you're borrowing £300,000 over 15-20 years, then certainly you want to be reviewing that every couple of years, because each change in provider can save you several thousands of pounds. I've seen some cases where customers have reduced their term, so they've brought it down X number of years. They've also increased the amount they've been borrowing, but because of the changes they've made with regard to the lender and the interest rates they've been charging, they're still saving money. Some of the differences can be quite extraordinary. So don't be disheartened if when you talk to a broker or you try and find a deal yourself, the interest rate is higher than you thought it would be, or the lender isn't one you hoped it would be, because it's in your interests and it's up to you to make sure that your business performance improves, your credit history improves, and your circumstances improve for you to then move on to a better deal down the line. Hopefully that's useful. I'm James Blacklaw's JB Commercial Finance. Please like and share, and I'll speak to you soon. Many thanks.